Sergio Ermotti, CEO of UBS, welcome to Bloomberg, sir. Looking at the top line this morning, Sergio, a miss on the full-year profit, the cost targets also under pressure, and you're cutting your midterm goals. Is this a serious reality check on how I look at UBS?
Well, if you look at the environment we have been operating in 2019 and the results up to the third quarter, the fourth quarter, despite being our best fourth quarter since 2010, could not really reverse the trend of 19. So if I look at the full year 2019, I can consider the results solid, considering the very challenging and mixed environment we have been operating in. In respect of the targets going forward, if you look at what they are, our targets were set back in September, October 2018 with a totally different expectations for example, for rates, for economic growth, and also for geopolitical uncertainty and how this would affect our clients. Now, as we enter 2020, if you look at what happened on all fronts, I think recalibrating the targets based on the fact that rates are down and not up, and the environment is more challenging is a natural definition. Now, the target have been stress tested. There is a range. We believe that even in very challenging environments, we can operate at 12%. In a more constructive environment, we can deliver a return on CET1 of around 15%, which makes us already today one of the best in the industry in terms of return on what we call deployable equity.
What does it take to get towards that 15%? What needs to happen to achieve the upper bandwidth, Sergio?
Well, I think that when I look at the upper band, we just need a more normalized environment. We are not looking forward huge tailwinds. If I look at our view on the growth opportunity in wealth management, growing at 10-15%. If you look at the IB going back into delivering a double-digit return on its allocated equity, which is more in line with what you saw in the last 7-8 years on average. If you continue to see our growth pattern in our Swiss business, in personal and commercial banking and corporate banking, if you look at asset management, you can see how all those actions, together with the fact that we are still managing the bank for more efficiency, both in terms of capital consumption and cost, you will get to the target of 15%.
I see that within wealth management, you're sticking to the 10 to 15% bandwidth. Is that because of Iqbal Khan and Tom Naratel's turnaround plan? Is that why you steadfastly stick with that profit before target for growth there?
No, look, if you go back, the targets we set back in 2018 for the 10-15% growth that we are reiterating today are just a reflection of the value and the position of our franchise. We are the only truly global wealth manager, and we have a reach in terms of footprint and capabilities that allow us to capture the wealth creation that we do expect over the next few years and decades around the globe, but particularly in Asia. I think that the needs for clients to get advice will continue to be there, no matter how technology and how new competitors may challenge. So I think that we have been working hard to reposition the business and execute on this strategy in 2019. In the last quarter, Tom and Iqbal have finalized those plans, and they have been already implementing many of the actions. And we are right now in full execution speed, and I do expect positive outcomes for the business.
Okay, we'll dig into those in just a moment. I see that there's a net, there's outflows of $4.7 billion, and you dropped the net new money target for wealth management. Talk me through that.
Well, first of all, as I always said in the past, we are not focusing on net new money in terms of quantity but quality, and the volatility each quarter of the net new money is shouldn't be overemphasized. So we still had a very solid net new money outcome for the year, particularly if you look at Asia, where we had a 9% growth, taking our client assets to 450 billion. Going forward, we are definitely dropping the net new money targets because I would describe the situation we are in terms of negative rates in euro and Swiss francs is driving us to a paradigm shift. Net new money will continue to be something that we look at, but at the end of the day, we are very focused on growing our business and growing our profitability. And net new money per se is not a good indicator of doing that. So actually, you can see how passive deposits sitting there, not really being deployed, is costing millions every year, and is also absorbing capital. So we're going to focus on quality of net new money and not on quantity going forward.
Can I just ask you then, in the past month, I'm just trying to get a sense of what's happened since the trade deal sort of took root in December. There was a shift in quoted markets. There was a shift in global sentiment. Have you seen that translate at a client level in activity in the past month, Sergio?
Yes, I think that if you look at, if you compare not only year on year, but also the more recent history in respect of client activity and going into late November and December, last year we saw a much more constructive and active environment. This is the reason why, as I mentioned before, we had our best Q4 since 2010. This good momentum is coming into 2020. I think that if you also look at clients do expect, and we do expect what the IMF also reported yesterday, a further drop in expected GDP growth globally, is somehow embedded in the market. The normalization of Brexit, the normalization of the trade tensions between the US and China is giving a little bit of more comfort to investors, and there is a need for a lot of this cash to be deployed. So there is a much more constructive tone, and the seasonality factor should not be forgotten. So I think that's, in that sense, we have a much more constructive view on Q4, on Q1, but still, the visibility and the volatility and the uncertainty remains there.
Sergio, can I ask you, you're re-rating the targets for the bank. I saw Deutsche Bank, we had a cut on the investment bank bonuses there. Will there be pressure on your bonus pool in 2019?
Well, of course, you look at our performance for the year, but in absolute and relative terms, it's only natural to expect that our compensation will reflect what we saw in 2019 and the operating environment we are in now. But more details on compensation will come out late in February.
You talk about Tom Naratil and Iqbal Khan's plan, putting that into practice. Your language that the bank used, which is a small number of roles will go. How radical a shake-up is this? Is it 500 jobs and done? Is it really that radical a shake-up, Sergio?
Well, look, to some extent is an evolution, and so the radicality of is probably more the fact that we have been delayering aspect of our management organization. I think that it's of course 500 people is a large number, but you have to put things in context. Is 2% of the workforce in wealth management, so is an adaptation and a simplification of our organization rather than a revolution. And this is over. So now we are focusing on execution, and we are focusing on delivering on our targets.
So we can expect no further shake-up within wealth management for the rest of this year?
Look, our wealth management franchise is very solid and strong. We don't need shake-ups. We just need to go into execution of the existing plans that we had and stay very focused.
And I know you and I chatted about this when we were in China, and I asked you about the proclivity for taking more risk with Iqbal Khan's plan to bring decisions, we understand, closer together, client and execution closer together. Has your proclivity for taking risk with wealth management changed as a result of this new plan?
I think that if you go back into the fact that we want to grow our loan portfolio and loan book by 20 billion a year, and we want to increase the interaction with the IB and taking on, in that sense, more risk is totally reflected in our 18 announced plan, and nothing has changed. So I'm glad we have Iqbal working with Tom in helping us executing on those plans, and I'm confident that the management and at all levels is focused on delivering on those commitments.
Sergio, can I just finish off with one question on the relationship between the UK and Europe? We've just heard from the Chancellor talking about, I suppose, not really trying to move towards equivalence. There could be some discombobulation, some uncertainty around that. Do you worry about the language that you're hearing from the positioning of the bank within the UK and Europe when you hear that kind of language?
Well, I think it's quite difficult to get worried about all those topics after what we went through in the last 2 years. So I think that, I always expected this Brexit topic to get to a more clear point and situation, but we have to be realistic that a lot of details needs to be nailed down, and on the uncertainty around all those topics will remain for the foreseeable future. But somehow this is now embedded in our plans, and we are, as I mentioned before, there are not a lot of excuses for us not to deliver on our targets.
Okay, and just finally on the share buyback, I see that you're finishing off what you promised to the market in 2018. Any guidance on share buybacks as we say goodbye?
No, I think we reiterated that we are committed to a very attractive capital return policy. We want to grow our cash dividend every year by $0.01. We're going to complete our outstanding 2 billion share buyback program in the first half of the year, if market conditions stays where they are. So by buying back 450 million, and we will reassess further buybacks late this year, depending on, again, on market condition and any idiosyncratic situation the bank may be in.